Hello and welcome to this Mutual Fund Corner special. Today we're going to talk about a very interesting topic. We're going to discuss all about sector and thematic investing. We get a lot of questions on this and we have just the person to answer all of them for you. We have Kalpesh Ashar joining us from Full Circle. Kalpesh, thanks a lot for joining us and taking out the time to, speak with our audience today. So my first question is that, at a time when we are talking about the market being very range bound, we're not expecting too much to happen on the index level. If you are looking for opportunities for alpha generation, does it mean that you have to get into sector and thematic investing? And is this a good time to be getting into those kinds of funds?
That's a very, very relevant question, Pavitra. And I think, like what we all know, and the evolved investors all know that right now it's not the time for alpha generation anywhere, be it in India or globally. And considering that the factors, which are favorable or not favorable, this is the time to maintain your discipline. And in equity, there is a time to persevere, and we are in that phase right now. So there's no, stage at which we are where we can say there's a lot of value to be unearthed or there's a lot of research to be done where we could find something else. I think we should just stick to the basics right now and do the simple the core aspects of investment, which is just stay there, not panic, and stick to the diversified equity funds, Pavitra. Now, as far as the sectoral and the thematic funds go, I have a very strong view from the beginning across business cycles when it comes to sectoral and thematic fund investments. So if you see that, even in today, the index, which we see the Nifty, constitutes approximately 35% of financial stocks or the banking stocks as we know them in a better way. And the remaining, I think, 10 to 20% could be constituting of IT. Now, if that is the core composition of the index, and if you, on a parallel basis, see the two topmost sectoral funds over a 1, 3, 5, and a 10-year period, then technology over the last 1 year, we know it has gone through a bad phase. It has given a return of almost 7.75% negative, a negative return of almost 8%. But over a 3-year period, it's 26%. Over a 5-year period, it's 20%. And over a 10-year period, it's almost 19%.
Yeah.
Similarly, banking also has given a very steady double-digit return over the 1, 3, 5, and 10-year range. Now, if that is the question, why should one enter into a thematic fund, you may ask, because the Nifty is probably emulating that, and the large cap, the investments also are more or less centered around that. Secondly, the point of getting panicky and moving from one sector to other is really not the handiwork of any retail investor. It's left to the fund managers. They know the pulse of the market. They know which sectors are doing well. And as we call the churning in the mutual fund portfolio is best left to them, whether it's a churning type of a tactic which they absorb or a buy and hold. It's best left to them.
All right, that point is definitely, well taken, and it makes a lot of sense to, put all of that data out as well. Kalpesh, a question that we get a lot is that if you do want to get into a sector fund, how do you pick? Is this whole, way of investing really about looking and sort of taking a contra bet? Do you go for the most downtrodden sector at that point and, where you perhaps expect that it will do well? Obviously, it may not make too much sense to go for something which has already rallied a lot, right? So how do you pick?
See, the problem is exactly the contrary of what you said, Pavitra, because we really don't know that when it's a downbeat sector, is it going to remain in that much phase or is it going to create a rise again? Most of the people, what they do, the cardinal mistake, what they do in sectoral investing is they get into a sector which is already done well.
Yeah.
Now that is the biggest problem which we face, and they really are already half the journey has been undertaken when these people decide to board onto the train. Now, the problem here is not getting into it. The problem is getting off a sectoral fund or a thematic fund, because the fund managers exactly know that a certain upbeat or a positivity in a sector is going to continue or has died down, and they also go wrong. It's not that they have completely hit the jackpot every time they've gone into a sectoral fund. So in fact, out of all the sectoral funds, just getting into a little bit of number crunching, Pavitra, I think technology is the only sector, if you see over a 3, 5, and a 10-year period, which is actually given a 20% CAGR, which is brilliant. But apart from that, I don't think any sector has been able to match that. Whereas a mid cap and a small cap diversified equity fund over a 3, 5, and a 10-year period has been able to come into the close, 15 to 20% type of a CAGR over a 3 to 5 and a 10-year period. So the odds are completely against a thematic fund. And technology, as we know, has been the blue-eyed boy of lots of retail investors. But you're also getting the same exposure without taking a risk in the large cap funds as well. So it's a very difficult trade-off. I would say that people do not know how to time getting into a sectoral fund and getting out of it. And if that is not done, again, stick to the basics, keep it simple and straight.
All right, we get that, and this is some interesting data that I'd come across once as well, which said that this is why your returns are never as good as the fund's returns, right? Because you don't know when to get in, you don't know when to get out as well. Are you then saying that this entire way of investing or these funds are best avoided for someone who's perhaps not too well versed with the markets?
Absolutely. There's no two ways about it, and people would like to always have an attractive alpha or something in their portfolio. But I don't think adding a lot many thematic funds, or in fact, adds to that alpha at all. In fact, if it doesn't do well, it could really create a void in your portfolio. And if you go according to your risk profile, you're better off sticking to create the alpha. You're better off sticking to the mid and the small cap segment in true proportion as per your advice of your financial advisor, as per your risk profile, and more importantly, as per your goals. Because clutching on from one thematic fund to the other, you're bound to slip somewhere and go off your complete financial investment process at a stroke. So don't get too lured by these themes or sectors. Mutual fund by nature, Pavitra, I would like to say, means diversification. And if we're into the mutual fund process for diversification, why do we then want to contradict our own thought process and stick to a certain theme and a certain sector? We are contradicting our own thought process, because then that becomes a concentrated type of an investment strategy, which is then best taken up by people who know the stocks very well. They might as well do direct equity then.
Yeah. No, I definitely understand that. And sometimes in the greed of saying that, okay, tech is doing well globally, Indian tech stocks are doing well, let me also put my money there, it can be quite a risky game to play. So that is on, I definitely understand that is on sector and thematic investing. But Kalpesh, you are someone who's been in the business a long time. You know how these funds fare, how the markets are. If someone is to ask you what your call is on, say, an IT fund or a financial fund, I'll ask you about only these two sectors in particular. Would you have any advice to give them? We do know that, of course, IT stocks have run up in the past few weeks as well. So again, the timing factor does come into play. But do you think that these kinds of stocks are likely to continue to do well for some time?
I would like to answer this in a more fundamental manner.
Go ahead.
That we've seen these technology stocks, and as I told you, the numbers speak for themselves over a 3 to 5 year, 10-year period, where we actually keep that horizon for mutual fund investments, or in fact direct equity investing. Now, if anybody is able to hold your investments for that longer duration, they've seen the results that they've got almost a 20% return. And right now, we know that from the cycle, again, I'm not timing or I'm not giving a call on it. We know that in the last, at least 2 years, since the US stocks and all have not done, that has taken a bearing on the Indian IT as well. I think the valuations in the IT sector, or I would say the IT funds, have yet not caught up as much as people would have desired. So I think IT is, as it is, a very evergreen type of a space. But again, look at your profile. Don't put, don't go guns blazing into IT. Take a limited call into IT. And second, banking. I think let's not answer that in an equity type of a questionnaire, but put it in more in perspective of a economy. So our economy today is on the cusp of growth, and without banking, I don't think that we are going to go anywhere. So the banking system is going to improve. The financial system is in strong hands. And obviously, if banking is an offshoot of that, the banking funds are an offshoot of that, they should do well.
All right, Kalpesh, very, very useful chat with you as always. Thank you very much for joining us and, bringing all of these points to the fore. And like you mentioned that, this is a risky game to play. If you are going to pick a sector or a theme, you're essentially trying to pick which one is going to do well, when is it going to stop doing well. And if you know that much, then perhaps direct equities is the way to go for you. But thank you very much for joining us today.
Thanks, Pavitra. Thanks for having me.